Hello, good afternoon. Welcome to the latest webinar from Carr, Riggs, and Ingram, GASB reporting entity standards, component units, and fiduciary activities. Need to cover a little bit of business right up front as you're continuing to stream in. This webinar is eligible for up to two credits, CPE credits under accounting governmental, but no partial CPE credit is accorded. So the full session is 100 minutes. We will make sure to go at least a few minutes beyond the scheduled end time at 40 minutes past the hour to make sure that everybody gets their full 100 minutes. You do need to stay on for the full 100 minutes in order to earn the CPE credit, and you need to answer a minimum of 6 poll questions during the webinar in order to qualify. There will be 8 poll questions total. Go ahead and answer all 8 just in case. But as long as you have answered 6 of them, it doesn't matter how you answer. You don't have to get the answer right. As long as you get 6 at a minimum and are online for a full 100 minutes, you'll get CPE credit. Be sure that you have logged in with the unique link that was sent to your registration email and stay logged in for the entire time on that device that you connected with using that unique link. The certificates for the CPE credit should be in your inbox within 7 days of this event. If you have any questions about the process of according the CPE credit, that email address right there, marketing@criadv.com, is where you should go. There will be a CPE survey in the web browser immediately following the webinar. Please take the time to respond to that. We take those results very seriously in planning our future webinars and in making improvements in how we deliver them. There is a PDF version of the slides that will be popped into the chat in the not too distant future. Otherwise, the chat is disabled. If you have questions, either technical questions having issues with the broadcast, or you have a substantive question that you'd like the presenters to answer, use the Q&A function. So one of the benefits of GASB not issuing as many new statements is that it gives us an opportunity to go back and look at some of the earlier pronouncements that GASB issued, particularly major fundamental and inherently complicated areas that maybe don't get as much attention as they should, but that everybody needs to understand and that have a very significant impact on a government's financial reporting. And the financial reporting entity is certainly one of those areas. And so we wanted to take the opportunity to go back through those standards as they stand right now and share our experiences in dealing with those standards with you, provide some insights, maybe introduce you to this area for the first time, depending upon how long you've been working in the governmental arena. By the end of the webinar, you should be able to identify the relevant provisions of GASB standards that cover the financial reporting entity, apply them to identify a government's component units, incorporate those component units into a government's financial statements, and then lastly, classify trustee and custodial activities that should be reported as fiduciary activities of a government. My name is Dean Mead. I am a government and public sector subline leader at Carr, Riggs, and Ingram and a partner. I've been with the firm for a little under 4 years now. And before that, I was on the staff of the Governmental Accounting Standards Board for 24 years, most recently as Assistant Director of Research and Technical Activities. Becky?
Thanks, Dean. Hi, I'm Becky Hammond. I am also a government and public sector subline leader and a partner in our New Orleans practice unit, doing 100% government audits, accounting, and consulting engagements, which is absolutely what I love to do. So happy to be here with everyone.
Good afternoon. My name is Matthew Montemayor. I'm also a member of the Government and Public Sector Subline Leaner and a partner with Carr, and Ingram out of the Rio Grande Valley Practice Unit. I have been in public accounting for a little over 16 years now and primarily dealing with the government and public sector industry. Happy to be here with you today.
My name is Pat Smith. I'm also a government and public sector subline leader. I'm a partner in the Bradenton, Florida office, and I've been working in public sector audits for the majority of my career, which has been close to 20 years now.
Well, thank you, everybody. You guys are in for a treat. Becky, Matthew, and Patrick are all experienced and very knowledgeable, and you just happen to have like the full set of government and public sector subline leaders as it happens in this broadcast. For your benefit, there's a slide up in the early part of the handout with some of the acronyms that you're going to see in the slides. For instance, no one wants us to repeat discretely presented component unit over and over and over again in the essence of keeping the font a readable size. We use DPCU on a routine basis and these other acronyms as well. Before we jump into the substance of the webinar today, we're going to kick off with our first polling question. How well do you understand GASB's financial reporting entity standards? Very well, pretty good, a little bit, or what's a GASB? This is, I think a lot of people will agree, a complicated area of the GASB standards, in large part because of the requirement to use professional judgment. And you will find throughout this presentation that certain decisions that need to be made will ultimately rely upon the judgment of the government to decide what's the appropriate path to go forward. And it's a good example, I think, of an area where governments and others are asking the GASB to be more principles based and give them the ability to use their judgment to decide how best to report. But as you guys probably know, whenever the GASB does that, they immediately get a million questions about how to apply the standards to specific facts and circumstances. So nobody ever seems to be particularly happy with the balance between professional judgment and rules-based standards. Why don't we go ahead and post the results? Excellent. So the 5% of you don't even know what the GASB is, haha. For the rest of you, there's at least a little bit of familiarity there. So hopefully by the time you're done, those learning objectives really will have been met.
Okay, so we're going to go ahead and start off. Where are the standards located? So component units have a number of different standard pieces that are involved with determining. We start out with the codification. There's 3 different sections in the codification that you can find component unit. So the 2100, defining the financial reporting entity, 2600, the financial entity and component unit presentation and disclosure, and then of course 1300 for fund accounting. And then of course you have a number of different GASB standards. Obviously 14 was the original that was later updated with 39. And then of course one that we don't have here actually is 103 is going to do a little bit of add a little something to the component units as well. And then if we get into the key terminology again, we have these different acronyms. I know everybody loves acronyms. So we have the financial reporting entity, which we're going to refer to as FREE, and then primary government, which we'll refer to as PG, and then of course the component unit, the acronym of CU. So you have to look at the boundaries of the financial statements and how the component units are intertwined within them. What we have is we'll have governmental activities and business activities, which are going to include the blended component units. which we'll get into the blended later on here. And then you'll have the fiduciary activities, which won't be included in the government-wide, but they may have a separate fiduciary component unit. And then, of course, you'll have discretely presented component units that'll be on their own in their own individual columns. So first off, we have to define what is a primary government. Okay, so most of us know like a state government and general purpose governments like municipalities, cities, counties. And then you might have different special purpose governments like a school district or a park district. Some of the three criteria that they have to meet to be the primary government is they have to have separately elected governing bodies. They're legally separate entities, and they're fiscally independent of the other state or local governments. So a primary government may also include other legal separate organizations. Component units are within that primary government, which you'll see here as we move on. First of all, defining that legally separate entity. So you have it's the organization has a separate legal standing if it is created as a body corporate or a body corporate and politic or otherwise possesses corporate powers. So the corporate powers is actually one of the, if you look at GASB 14 and you do this step-by-step analysis that I'm familiar with, where you do yes, no, determining whether it's a component unit, the very first step is, does the potential component unit have separate corporate powers? And the corporate powers are going to be, does the entity have the capacity to have a name? Do they have the right to sue or be sued? And do they have the right to buy, sell, lease, or mortgage property in its own name? Those are some of the characteristics that are going to give it separate corporate powers. So then we move on to the fiscally independent. So fiscal independence for the government is going to be that this entity is going to have the authority to do all the following. They're going to have a budget. They're going to levy taxes, set rates or charges, and then they're going to issue bonded debt. All of these are going to be necessary to make sure that they're fiscally independent from a primary government, to make them a primary government. So we're legally separate as a component unit. So why is the component unit included in the primary government's financial statements? So the main reasons being the primary government is financially accountable for the component unit. That's one of the big ones, right? So they're acting as the shepherd over their fiscal responsibilities. It exists. The component unit exists for the benefit of the government or its constituents. Maybe it's like a CRA or like a solid waste or something that is part of the county. That it's for the specific benefit of that county, maybe or city. And then the third one is excluding it would cause the financial statements to be misleading. So it needs to be included because it, in essence, is a part of that primary government. And I think that takes us to a polling question, Dean.
Indeed, it does. So polling question number 2, fiscally independent means an entity can do what without the primary government's approval? Determine its budget, levy taxes or set fees and charges, issue debt, or all of the above. Harking back for a second to that slide that Pat showed that had the list of all the GASB pronouncements that the financial reporting entity standards derive from. A lot of people debate over how they prefer to access GASB standards, whether through the original versions of the statements or through the codification. I have to say, with respect to the financial reporting entity, I don't see how you can possibly apply these standards by looking at the original statements because they have been amended so many times, particularly Statement 14. And so you really need to focus on those three codification sections when you're applying the financial reporting entity standards because they are completely up to date and they reflect all of the amendments that have been made in the years since Statement 14 was issued, which now was well over 30 years ago. So if we've got close to 100% response, we can push out the answer to this question. And 90% of you are absolutely correct. All of those are true. An entity is only fiscally independent if it can, without approval of another primary government, determine its budget and levy taxes or set fees and issue debt. It doesn't mean that it does necessarily issue debt, but if it wants to, it doesn't need a primary government's permission to do so.
All right, so I'm going to jump into learning objective number 2, which is applying the standards to identify a government's component units. So we start off first with financial accountability. So what does it mean to be financially accountable for a legally separate organization? So there are certain circumstances that outline a primary government's financial accountability, and those 3 circumstances are listed here on this slide. If a primary government appoints a voting majority of the organization's governing body, and, keyword being and, can impose its will on the organization, and or there is a financial benefit or burden relationship with the organization, then the primary government is considered to be financially accountable. Now, this doesn't necessarily mean that the primary government is considered those charged with governance. However, if they essentially are taking ownership of the individuals that they appoint and the outcomes that those individuals are making on the governing board. If the organization is fiscally dependent on the primary government and there is a financial benefit or burden relationship, then the primary government is considered to be financially accountable. Now, this is regardless of whether or not the separate organization has a separately elected board. If the organization elects its own board, however, if they are still fiscally dependent on the primary government, then the primary government is considered to be financially accountable for that separate organization. And then lastly, the last circumstance here is if the primary government holds a majority equity interest in the organization that does not meet the definition of an investment, then the primary government is considered to be financially accountable. The key words here being majority equity interest, which would, to me, mean some sort of control and also does not meet the definition of an investment. So breaking down the terminology, appointing a voting majority. So a voting majority is often a simple majority of the organization's governing board, unless a greater proportion is required for financial decisions. So in some instances, separate entities might require a supermajority vote for certain financial decisions or all financial decisions. If that's the case, they would normally require maybe 50% of the board to pass something on the agenda. If they require 2/3 of the vote, then that's a supermajority or more than a simple majority. And if they have a supermajority requirement, however, the primary government only appoints a simple majority, then the primary government wouldn't be considered financially accountable for that organization because they are only appointing the simple majority and not the supermajority that is required. So key concept here is that the primary government needs to appoint the voting majority. The primary government's appointment authority must also be substantive, not merely confirming appointments made by others or selecting from a slate of candidates. So here they have to have full control. Their appointment authority cannot be limited. An example is if a slate of candidates is presented to a primary government that was determined by a separate group of individuals, and the primary government had to select from that slate of candidates, well, their appointment authority is limited to only that slate of candidates. So that wouldn't be considered a substantive appointment authority. If the primary government makes initial appointments but does not have continuing appointment authority, the primary government can still be considered financially accountable if it can unilaterally abolish the organization at a point in time. So some next level financial reporting entity or free knowledge. Some governmental entities such as pension plans may not have a governing body or board. Does that mean the appoints a voting majority criterion cannot apply? The answer here is no. And that's because if a pension plan is administered through a qualifying trust and the primary government performs the duties that a governing board would typically perform, it is the same as appointment of a voting majority. This no board provision applies to all potential component units except defined contribution pension plans, defined contribution OPEB plans, and other employee benefit plans such as 457 plans. Jumping into the next terminology, imposition of will. What does it mean for a primary government to have the ability to impose its will? Now, we recall, one of the first circumstances, if the primary government can appoint a majority of the separate organization's board and can impose its will, then, or a financial benefit or burden exists, then they are considered financially accountable. So what does it mean to impose its will? So basically it means, if they're able, the primary government is able to significantly influence the organization and its programs, projects, activities, or levels of service. The standards do lay out it's a list of abilities that are indicators of imposition of will. Those indicators are listed here. If the primary government had the ability to remove appointed board members at will, that would be an indicator of imposition of will. If the primary government was able to modify or approve the budget and or rate or fee changes or veto, overrule, or modify board decisions, that would be an indicator of imposition of will. And then lastly, if they were able to appoint, hire, reassign, or dismiss management, those individuals that are responsible for the day-to-day activities, then that would also be an indicator of imposition of will. And we see here the similar to the appointment authority is, these abilities have to be substantive and not merely ministerial or compliance oriented. A compliance oriented example would be, say, a separate organization adopts a tax rate. And that tax rate is reviewed by the primary government to ensure it's within certain levy limitations. Well, that's a compliance-oriented approval, and it's not wouldn't be considered a substantive approval in that regard. And next, I believe Becky is going to lead it off on covering financial benefit or burden and fiscal dependency.
All right. So financial benefit or burden is one of the key tests for determining whether an organization is a component unit of a primary government. Primary government has a financial benefit or burden relationship with another entity if it's financially intertwined in a way that exposes it to gains or losses. This is a great way to think about that as we go through all of this criteria. So basically, the benefit or burden may result from some kind of legal entitlement or obligation, or it could be less formalized than that and exists simply because of some kind of decisions made by the primary government or something that it's included in an agreement with that organization. And these effects, because of this financial benefit or burden, could be either direct or indirect, depending on the structure and the relationship of how everything functions. So, in order to determine if you have a financial benefit or burden relationship, these are the things that you're going to be looking for. Are they legally entitled to or can otherwise access the organization's resources? Is there some kind of legal obligation, or has there otherwise been some kind of assumption of an obligation to finance any deficits of the organization or to provide financial support? And remember, this wouldn't simply be a grant or a contract that creates this relationship. There has to be some kind of tie to some kind of financial exposure here. Something else you would look for would be if they've obligated in some manner themselves to be obligated for the organization's debt. Debt guarantees are definitely one of the strongest indicators of burden, and ones that we see a lot in component unit relationships. And the bottom one here, legally obligated or has otherwise assumed the obligation to contribute to any kind of pension or OPEB plans that are administered through a trust. So, that in and of itself creates a burden relationship as well. A few more, ability to access the organization's resources. Whether that's an actual transaction or not, it's the purpose of this one is that this is an important factor for determining if they're legally entitled to those resources. So again, whether that's actually happened or not, the point is whether they can have access to the resources. And then this last one, if there's a residual interest in an organization's net assets in the event it dissolves, not equivalent to being entitled to its resources. So, for example, it's presumed that the organization is a going concern. So the big thing here with benefit and burden is if the entity succeeds or fails, does the government financially win or lose? And if that answer is yes in either direction, you likely have a financial benefit or burden relationship. So kind of keep that in mind. Financial benefit or burden is about who ultimately shares in the financial risk and rewards. And if the primary government is on the hook or gets the payoff, the entity probably belongs in its reporting entity. Few other debt-related items. Being obligated in some manner for the debt of an organization means that the primary government is either legally obligated to assume all or part of the debt in the event of default, or has taken or indicated it will take action to assume some kind of secondary liability for all or part of the debt. That obligation can be expressly or specifically implied. And I mean, we see this a lot from a conduit debt relationship, where we then have to determine what the relationship is between those entities. At least I do that. I do see that a lot in a lot of my engagements. So, what are some conditions that might indicate that a primary government has obligated itself from the debt consideration side? First is legally obligated to honor deficiencies, being required to temporarily cover any deficiencies with its own resources, requiring the primary government to provide funding for any reserves, the primary government being authorized to provide funding for reserves and then actually establishing a fund for that, identifying in a bond agreement or other contract that it may cover deficiencies despite not being legally required to do so, or if it's probable that it will assume responsibility based on some kind of legal decisions with the state or its prior actions in similar circumstances. So these are things that you want to look for if you're looking for the primary government being obligated to cover deficiencies in those circumstances. This next concept is fiscal independence and dependence. So as we kind of went over before, fiscal independence means that a government has the authority to do all of the following without substantive approval by a primary government. It means on its own, it can determine its budget, it can levy taxes or set rates or charges, and it can issue bonded debt. Um, a government is fiscally dependent if a primary government has approval power over any of those three. So I know in applying these standards, these are two terms that often get confused with each other. But I want to make sure that we look at this and ensure you really have to determine fiscal independence first. And then later on down the line, when you're going through all your steps, is when you look at the fiscal dependency part of the standards. So a government may be fiscally dependent on a primary government, even if it doesn't receive financial assistance. I have a great example of this. I had a library board. They're its own separate entity. They have uh, two pieces of this where they can determine their own budget and levy their own taxes, but they can't actually issue bonded debt themselves. So they are not fiscally independent of the parish in which they operate in. I'm from Louisiana, so we have parishes instead of counties, but the same concept as a county. So this library and all the libraries that are set up in that same manner have to wind up being considered component units of that primary government that they're established under. So, just a good example of that. And the reason is because they're not independent, they can't issue their own debt.
Time for our next polling question. So, which of the following is not a financial benefit or burden? Primary government is legally entitled to the entity's resources. The primary government must pay off the entity's debt if it defaults. Most of the entity's revenue is grants from the primary government, or the primary government covers the entity's budget deficit. So remember, in this question, it says, which of the following is not a financial benefit or burden? And while you're answering, two things I want to add to what you've heard so far. If you were looking at that last slide and saying, hey, didn't they already talk about fiscal independence? We did, but it's relevant to two separate decisions, as Becky was talking about. It's first relevant to determining if an entity is legally separate and can be a primary government, and then it is subsequently also a factor to consider when determining when evaluating financial accountability, whether the potential component unit is fiscally independent or fiscally dependent, because if it's fiscally dependent, that's one of the indicators that suggests it's a component unit of the primary government. When we're getting pretty close to everyone having responded, you can go ahead and push out the answers. So most of you identified the third option. Most of the entity's revenue is grants from the primary government. You're right. That has nothing to do with financial benefit or burden, and it can work in either direction. An entity could get all of its revenue from a particular government, and that doesn't make it a component unit of the government. Or it could be, and many component units don't really get any financial support from the government, but the primary government is determined to be financially accountable for it, and for that reason includes it in its financial statements as a component unit.
All right, jumping into some more next level free knowledge. So here we have a transit district receives almost half of its revenue from an operating subsidy from the county. Does that mean the district is fiscally dependent on the county and should be reported as its component unit? Well, the answer here is no. Financial reliance is not the same thing as fiscal dependence or financial benefit or burden. An organization may rely heavily on revenue from a government and not meet the criteria for fiscal dependence. And likewise, an organization may also be fiscally dependent on a government, but receive no revenue from it. So let's talk a little bit about majority equity interest. Again, this is one of the third circumstance here on applying the standards for determining a primary government component units. A primary government is financially accountable if it holds a majority equity interest in an organization that does not meet the definition of an investment. Now, the key thing to take away from here is that the financial interest in the legally separate organization needs to be evidenced by some form of ownership of shares of stock or having an explicit measurable right to the net resources of the organization. They have to be able to demonstrate explicit and measurable to determine that they have a majority equity interest. And then also the majority equity interest does not meet the definition of an investment. So to apply that, you really need to know what the definition of an investment is. So an investment is a security or other asset that A government holds primarily for the purpose of income or profit, and B, has a present service capacity based solely on its ability to generate cash or to be sold to generate cash. So if it meets that definition of an investment, that majority equity interest wouldn't meet the criteria for recognizing a component unit. So let's look at this in some next level of free knowledge. So say a county seeks a new revenue source. So they're seeking a revenue source by buying a majority share of a real estate development firm. So majority share in majority equity ownership there. And this real estate development firm converts industrial and commercial buildings into residential units and sells them. Is the firm a component unit? The answer here is no. And the reason being is because the county intends to profit on the sales, not just to provide public housing. So its majority share of the firm is more appropriately identified as an investment. On the flip side of that, say a county purchases an asphalt business with a group of cities and it takes a 60% stake. So the 60% there's your majority equity interest. Is this business a component unit? So yes, this could be considered a component unit if the purpose of the purchase is to lower the cost of the government to acquiring asphalt for road construction and repair projects rather than selling the asphalt. They're not looking to sell the asphalt to get some sort of revenue or profits from the sale. They're using it as a purpose to lower the cost of acquiring asphalt for road construction and repair projects throughout the city. So also including component units, what does it mean to exist for the benefit of the government and or its constituents? So say the primary government is not financially accountable. A tax-exempt organization could still be considered a component unit if all of the following are true. So keyword here, all. All of these requirements need to be true in order for the separate organization to be considered a component unit. The first is if its resources are entirely for the benefit of the primary government or the primary government's component units or constituents, and the primary government or its component units can access or is entitled to a majority of the organization's resources, and the resources are significant to the primary government. A key example here would be fundraising organizations. Some public universities may have alumni associations that are specifically there to raise funds. If the primary government, those resources, those fundraising monies are for the direct benefit of the primary government, well, yes. And can the primary government or can the public university access or is entitled to a majority of those resources? If that's answered yes, and those fundraising funds are significant to the primary government, well, then it would meet all three of those criteria, and the separate organization would be considered a component unit. Another way to include a component unit if it is misleading to exclude. So If an organization is not required to be treated as a component unit based on the preceding criteria, there's no financial accountability, it doesn't exist for the benefit of the government or its constituents, a primary government should include a component unit if it would be misleading to exclude the organization. Now, this is where some professional judgment comes into play, right? So in other words, leaving out the organization would cause the primary government's financial statements to be misleading. So here, this determination, you want to be sure to look at, the nature and significance of the relationship, and you apply professional judgment to determine if that nature and the significance of that relationship would cause your financial statements to be misleading. If you answered yes to that, then you would include that component unit. Some more next level free knowledge. If an organization meets the criteria for inclusion as a component unit for two primary governments, should both include it in their financial statements? The answer here is no. Organizations may be included as a component unit in only one financial reporting entity. Again, here you see professional judgment. You should use professional judgment in evaluating which government it includes it. So, usually the determining factor here is going to be fiscal dependency. So you might have a situation where a separate organization board is appointed by a primary government, and that separate organization is also fiscally dependent on another primary government. Well, the fiscal dependency factor is usually going to be the determining factor of which financial reporting entity that separate organization is reported in.
Thank you, Matthew. That brings us up for our next polling question. Misleading to exclude means an entity should not be included in a primary government's financial reporting entity, or if an entity is left out, the primary government's financial statements could mislead the reader, or a primary government is trying to hide its relationship with the entity, or none of the above. So an example of this type of situation might be some kind of regional entity that is created by two neighboring governments that both have a role in appointing the board. They both have a role in signing off on certain financial decisions, and looked at separately without considering the other government that helped to create this entity. You might come to the conclusion that both of them could conceivably look at this regional entity as a component unit. And ultimately, though, professional judgment is going to indicate which one it belongs in, which set of financial statements it belongs in. I've never seen one where it's just a toss-up. There's always some determining factor that suggests it belongs in one and not the other. If we're close on the responses, we can push out the answer. And 70% of you got the right answer here. Remember, you don't have to get the right answer. You just need to respond to get the credit. But what misleading to exclude means is if the entity has been left out of the primary government's financial statements, those financial statements could mislead a user of them.
Okay, so now we're getting into something else here. So you're not a blended component unit. You're not a discretely presented component unit. Instead, you're what's called a related organization. So I have an example like Florida County might have, say, this workforce development board. The county commissioners are going to appoint the members of this workforce development board, but the county doesn't actually provide any funding to this board. There's no obligation for debt, and it can't impose its will, like Matt was talking about earlier, over this board. So this is what's going to be called a related organization. And how this works is you're going to include in the notes in the SSAP, like the nature, of this organization and how it relates to the primary government. Of course, you have to remember that even though you're disclosing this in the SSAP or the Summary of Significant Accounting Policies, you're not actually going to include it within the reporting entity. So the numbers aren't going to come together within the reporting entity of the primary government. And then for some additional next level free knowledge, applying the free standard requires a lot of professional judgment. Can a primary government determine that a legally separate entity is not a component unit based on professional judgment? And the answer is no. A primary government may use professional judgment to determine that a legally separate entity that does not meet any of the specific criteria should be included as a component unit because it would be misleading to exclude, but it may not use professional judgment to omit the entity that meets the component unit criteria. So you don't want it to be misleading to exclude it. So you're making a professional judgment here, but you can't say, you can't use professional judgment to say, oh, we're just going to omit it.
All right, now we're moving on to our learning objective number 3. How are these component units going to be reported? And this is going to incorporate the component units into the government's financial statements. So our first determination is we've determined that we have a component unit, but now we need to determine whether we're going to present that discrete or as a blended component unit. And the default option for reporting a component unit in a primary government's financial statements is that discrete presentation, which is a separate presentation that is displayed in a column on the statement of net position after the total for the primary government, or in a row in the statement of activities after the totals for the primary government. Any primary governments that have multiple discretely presented component units will generally combine those into a single column or row and then present a combining schedule in the back. And any component units that meet the criteria for blending are going to be reported within the primary government. So just remember these concepts. Discrete means separate presentation. Blended means it's folded into the government. So when we're blending, there are anyone that meets the criteria for blending is going to report that activity in both the government-wide and the fund financial statements. This is often reported as a single fund, or it may be combined into another fund. I've seen that quite often in a number of my larger entities. However, if the component unit reports funds, then they should be reported among the appropriate funds of the primary government. So again, looking at the nature of the activity associated with that blended component unit and determining where does it best fit in the picture of the full government, primary government picture of their financial statements. So when is a component unit blended? Well, it's going to be blended if any of the following criteria are met. The first is when our governing bodies are substantively the same. This can include if it's a financial benefit burden relationship, and or if the primary government has operational responsibility for the component unit. It would also be blended if the component unit provides services entirely or almost entirely to the primary government, so more like an internal service type relationship. Some examples of this would be like a building authority that serves only the city. Another example, another criteria for blending would be if the component unit exclusively or almost exclusively benefits the primary government. The component unit doesn't have to provide the services to the primary government, but just has to benefit the primary government. So, examples of that would be maybe like a recreation development commission or library board. I've seen a number of those types of situations where um, they're basically functioning like a department of the city, even though they're their own separate legal entity. They're so intertwined with the city or the parish or the county that they meet this definition of being, exclusively or almost exclusively providing benefits for the primary government. So just remember, if it functions like a department, it gets blended. Another example would be if a component unit's outstanding debt is expected to be repaid entirely or almost entirely by the resources of the primary government. A great example of this would be like a finance authority that was set up just to handle the debt for a city or a county parish. Or I've seen a board of liquidation for a city where all they do is handle the debt. And then another example would be component unit that is a non-for-profit or corporation in which the primary government is the sole corporate member. Um, we see this a lot with senior centers or ARC organizations, things like that, where it may have started off as a non-for-profit, and then the government had to take it over for some reason or another, and winds up being the only corporate member. So ultimately, just ask, is this entity basically part of the primary government's internal structure? Um, or in other words, is it separate in form but not in substance? Those are the questions that you want to ask yourself with this. So some more next level free knowledge. If a blended component unit reports multiple funds, including a general fund, should the primary government report two general funds? And the answer here is no. A primary government should only report a single general fund. The general fund of the component unit usually will be reported as a special revenue fund.
Thank you, Becky. Time for our fifth polling question. A component unit's debt is repaid entirely with resources of the primary government. How should that component unit be reported? Pureed, mixed, blended, or liquefied? I think I covered most of the settings on the blender I have in my kitchen. A couple things I want to mention for those five circumstances in which a component unit is required to be blended. Uh, the fourth one, the debt is entirely or almost entirely repaid with resources of the primary government. That was added by GASB Statement 61, which was the result of the first time that GASB went back and re-examined how Statement 14 was working in practice. And 61 did two things of great significance, I think. The biggest of those was really emphasizing the existence of a financial benefit or burden relationship when evaluating whether something is a component unit of a primary government. That there might be instances in which a government has a lot of influence over an entity. It has the ability to appoint all of its members, maybe like a historical society, but there is no financial benefit or burden relationship. And so a lot of those entities got pulled into the financial statements of primary governments, but really there was no financial accountability there, and it didn't really add any value to the primary government's financial statements to have those entities included. And so as a result of Statement 61, those types of entities ended up dropping out of the reporting entity. And then what I think is, personally think is the most important thing that 61 did was it added repaying debt with the primary government's resources as a blending requirement. And the reason I think that is because there was this real proliferation that it started before Statement 14, but then really took off of governments creating these legally separate entities to issue debt on their behalf. And this debt may be legally the responsibility or obligation of that finance authority, that was created legal to be legally separate. But that finance authority really doesn't have any resources of its own. It repays that debt with appropriations from its primary government. And so even though the legal arrangement makes it look like that's not the primary government's debt, everyone understands that economically that primary government is on the hook for that debt. And so prior to Statement 61, those component units would have been discretely presented, and GASB decided that to accurately show the amount of outstanding debt of this government, those types of entities needed to be blended into the primary government. All right, why don't you push out those results? And if it's anything but blended, you guys are just jerking my chain. Ha ha, very funny, pureed, mixed, liquefied. Everyone knows we're talking about blended here. We've used that word over and over again. But thank you for giving me a good laugh. So I'm going to cover this slide too. If a component unit meets the criteria for blending and is included as a special revenue fund, should it always be reported as a major fund? You guys know that when governments are reporting governmental and enterprise funds, their financial statements present the major governmental and enterprise funds individually in their own columns, and then aggregates all the other ones as non-major governmental funds and non-major enterprise funds. And the primary way that something becomes a major fund is that it meets these quantitative criteria that show that it's a certain size relative to the government as a whole. And so the question here is, if you're bringing a component unit in and reporting it as a special revenue fund, is it automatically a major fund? And the answer is no. It is subject to the same quantitative criteria as any other governmental or enterprise fund. And so it will be reported as major only if it meets those quantitative thresholds for major fund reporting, or the primary government decides to report it voluntarily as major because it believes it's important to do so. If it's for a governmental fund, for instance, 10% of all of the governmental funds, assets and deferred outflows, or liabilities and deferred inflows, or revenues or expenditures, and 5% of the governmental funds and enterprise funds combined, it meets those criteria and it's going to be reported as a major special revenue fund. But otherwise, it's going to be reported as non-major unless, as I said, the government decides voluntarily to treat it as a major fund and put it in its own column.
And that's kind of what we're talking about here, Dean, kind of the qualitative standards for why the component unit might be determined to be major as for its relationship to the primary government. The services provided by the component unit to the citizens are such that separate reporting as a major component unit is considered essential for the financial statement users. They want that component unit to stand out in the financial statement so people can see the activity of the component unit specifically, instead of it being blended with within like a special revenue or something. And then there are significant transactions with the primary government and the component unit, so they want those significant transactions again to stand out so that the reader can see exactly what's happening between the two. And then maybe there's a significant financial burden, benefit or burden relationship with the primary government, like Becky was talking about earlier, that benefit burden relationship. So they have that, so they want that to stand out as a major component unit. And then here what you have, major component units should be reported in the basic financial statements in one of these two ways, right? So it's going to be on the face of the financial statements, and then, or it's going to be combined. It's going to be in the combining financial statements. The option to disclose this as a major component unit in the condensed financial statements in the note has actually been eliminated with GASB 103, which is the new standard coming out this year. So you might have to take that into consideration if you're an entity that's reporting these component units and how you're presenting. Let's go to the next slide. Let's look at a couple of examples here. So what you have here is you have the statement of net position with the primary government, and then you have these two component units. They have a water utilities and a housing finance corporation. And what you're doing is you're having the component units list out as major, and they're standing out. Obviously, another thing to notice here is they do have separate financial statement dates, with the water utilities being February year end, and the Housing Finance Authority being a December year end. We can discuss that more further. Dean, is that what you were saying about this one specifically, how they have the different dates? They still want to be shown as major component units. And then if we go to the next slide, we can see the statement of activities. Again, you'll see highlighted here, you'll see with the water utilities and the Housing Finance Corporation, you'll see that they have their own separate major areas within the statement of activities.
Yeah, and Patrick, they don't have to do this. This is the city of El Paso. They could have shown all of both of these discretely presented component units in a single column, and then presented them individually in combining financial statements. But what you mentioned, statement 103, what that emphasizes is you can show them individually on the face, but only up to the point that they don't diminish the readability of the financial statements. So just looking back at this here, if there are no discretely presented component units, you have three basic columns for most governments: the governmental and business type activities, and the total primary government. GASB doesn't say how many discretely presented component units you can show individually before you cross that line to diminishing the readability of the financial statement. My personal feeling is if it's any more than two, it starts to look like a fund financial statement rather than the consolidated government-wide financial statements.
Right. And that might be an instance where you'll show them in the combining statements in the back. If you go to the next slide, we can show how that's presented, where you'll have these in the back, where they'll show the individual component units, and then they'll combine them, and then show those up front. So then you have the statement of activities there, where again you'll have the separate component units are over there on the right, the energy authority and the airport, and then you'll have the non-majors combining there. So we've got some more next level free knowledge. Everybody loves the free knowledge. I don't know if anybody even remembers what the acronym stands for at this point, but a university reporting single column financial statements has a component unit that meets the blending criteria. Should the component unit be reported in combining financial statements with the basic financial statements? No, they should not. A blended component unit of a business type activity is blended by consolidating it with a single column of the primary government and presenting condensed combining information in the notes to the financial statements.
And the difference here being that we're talking about a blended component unit, not a discretely presented component unit. In case anybody thinks that this answer contradicts what Patrick was just talking about with respect to major component units. That's a discretely presented component unit concept. That brings us up to poll question number 6. How can major component units be reported by a primary government? Individually on the face of the government-wide financial statements, in combining financial statements, in condensed financial statements in the notes, or both 1 and 2? I know you guys have been monitoring the questions. Is there anything that has popped up that we might want to take on now?
There's not a lot of questions, Dean. I think we're doing a great job. I don't see any questions coming up.
Either that or we are completely baffling everyone. It is a very challenging area, which is why we picked it as the first webinar where we wanted to go back and go through some fundamental parts of GAAP, uh, uh, from start to finish. But
And this is a
sorry, go
Dean,
ahead.
this is something too, like if you're a finance director at a government, it never hurts to reevaluate some of these sometimes, right? So the circumstances may change. It never hurts to just reevaluate these every year.
I would be of the opinion that that should be done every year, Patrick. Uh, it may be a simple thing to do if nothing has changed in the nature of the relationship between the entities. But every year, if you're making this decision about what's in the financial reporting entity, that's based upon at least affirming what you've decided in prior years about these entities that you consider to be component units and whether they should be discretely presented or blended into the primary government.
And I would say, Dean, it's a good time since we have GASB 103 coming up that will change the presentation of, you know, for some of the financial statements that we're working in, that it's a good time to revisit this as well.
I would agree. And there's another thing about Statement 103, and I don't have the exact language in front of me, but with respect to major component unit reporting, it wasn't just 103 doesn't just eliminate the note disclosure option. The language around what is how you determine what is considered to be a major component unit is a little bit different from what was in the prior standards, and so everybody ought to take a look at that. I don't think it's going to result in very many changes from major to non-major or vice versa, but do note that the description of what constitutes a major component unit is a little bit different under Statement 103. So 82% of you said one and two are both options for reporting major component unit information, and you are correct. That third option in condensed financial statements and the notes is no longer, once you've implemented 103, no longer allowed. So some next level free knowledge, I'm sure, Patrick, that everyone remembers. FRE is the financial reporting entity. Um, if a component unit has a different fiscal year from the primary government, which year's component unit financial statements should the primary government incorporate into its financial reporting entity? This is why Patrick made a point of noting that the city of El Paso, which has uh, uh, an August 31st fiscal year end, its two discretely presented component units both have different fiscal year ends. One has a February 28th fiscal year end, and the other a December 31st fiscal year end. So statement the reporting entity standards address these circumstances in which the component units have different fiscal year ends, and it tells a government which fiscal year for the component unit it should be rolling into its financial reporting entity. And you see the answer here is that in general, the primary government should incorporate the financial statements for the component unit's fiscal year that ended during the primary government's fiscal year. So if you were to scroll back, I'm not going to do that, but you scroll back to that page that showed the El Paso financial statements. That was for, I believe, their August 31st, 2025 financial statements. And the water utility, which I think has the February 28th year end, it was their February 28th, 2025 year end. And for that housing corporation, which has a December year end, they were including the December 31st, 2024 financial statements for that component unit in their primary government. This is an issue touching on Statement 103 again, very briefly. There is an implementation question from last year's implementation guidance update that talks about a component unit that has a December 31st fiscal year end. The primary government has June 30th. So the primary government's implementing Statement 103 for June 30th, 2026. If the component unit was all on its own, under the effective date for 103, it would implement for December 31st, 2026. But because it has to be rolled up into the primary government's financial statements as of June 30th, 2026, that component unit actually needed to implement Statement 103 for December 31st, 2025, in order for the primary government to include it.
We do have a question, Dean, that it
Okay.
might be good to go ahead and take before we jump into the next reporting section. And that question is, how should the primary government, which is a school board, report the charter schools that have their own boards and they are not a financial burden and the primary government is not responsible for their debts?
Mm. Uh, Here's the simple answer. I can't answer that question without knowing a lot more about the relationship. And the reason for that is that the way that charter schools are set up varies a lot from state to state. And I just happen to be looking at a Florida school district recently that has a ton of charter schools. And a lot of other counties in that state also have a lot of charter schools. But then I also happen to be looking at a state where all the charter schools are creatures of the state, and the state reports them all as component units. So there's a lot that, as you've seen, a lot that goes into determining whether something's a component unit, and so it really depends upon the circumstances in a particular state as to how those charter schools are created and whose responsibility they are. I can tell you that if you go to our website, CRI adv.com, and go to under industries, go to the government section. Uh, there is a little carousel there that has all of the articles and resources related to government that we've published. And in there, you're going to find two articles. One specifically about charter schools and applying these standards. One that talks about whether charter schools are component units and walks through each of these steps that we've talked about up to this point. And then a second one that once you've identified whether charter schools are component units, how they should be reported.
I couldn't agree more, Dean. We've seen a number of instances here in Louisiana where, we've had to report it different ways depending on the relationship between that charter school and the school board.
That was a good
All right.
question. Thank you for asking it.
So moving on to reporting non-major component units. If major component units are presented in combining statements, then the non-major component units should be aggregated in a single column. Remember, the non-major component units are those that do not meet the quantitative thresholds for major classification, and that's going to be different for every primary government organization when you're computing that. So that will have to be calculated and determined in order to determine what's going to be considered major and be presented separately in that combining statement and what's going to go into the single non-major column. Any governments that prepare an ACFR should present combining statements of the non-major component units as well as supplementary information. Other governments can do that as an option if they so choose. And a lot of my clients actually do that just for transparency purposes in order for everybody to be able to roll up all the pieces and parts. So often you may see, the in the primary statements at the front, the government-wide statements where we have the totals, then a combining statement that's going to have your major with a single non-major column, and then a supplementary information schedule that has all of the non-major component units listed.
Becky, if I can add one thing there, just in case anybody uh, was, thinking about the that question about major uh, governmental and enterprise funds, because you mentioned quantitative. Unlike the major fund determination, where GASB says this is the quantitative threshold, with respect to determining something as a major component unit, GASB doesn't say how big a component unit has to be relative to the primary government and relative to other discretely presented component units. That's a judgment that each primary government would make on their own. But it would be accurate, I think, to say that the thing that tends to determine whether something is major is how big it is.
Absolutely. Although I have seen, as you point out, that there are times where it is such a qualitative factor
Yes.
um, that you wind up presenting it as major because of the significance of the entity. So definitely a consideration that has to be done on an individual basis. All right, for fiduciary component units, these are going to be reported only in the fiduciary fund financial statements of the primary government. If there's a fiduciary component unit that has like sub fiduciary component units of its own, all of that is going to be presented as a combined, that information will be combined um, and aggregated with the primary government's fiduciary funds based on the classification of the fiduciary funds. So that can get pretty hairy. I've seen some interesting examples of that, but just know that that does have to be combined.
This part of the standards always makes my head hurt.
Yeah, absolutely.
Component units of component units.
And to talk further about component units of component units, if you have that situation, then you really have to look at the data from all of the component units. It should all be included when you're incorporating it into the financial statements. You basically got to look at that from a bottom-up approach. And when you think about it, accountability doesn't stop at one layer, right? GASB looks through the full organizational chain. So, what you're trying to do is be transparent. And so you're trying to make sure that you include all of the information that should be relative to that primary government. So this can get a little challenging because sometimes it's a little tough to figure out, well, how do I add the primary, part of the component units numbers plus their component unit pieces and add them together to then put them in as our component unit. I've seen some challenges with this before, but when in doubt, you just make sure you can add a note to explain it in the notes. But here's an example. We've got a city government that reports a school district as a component unit. I haven't seen this too often, but I'm sure that it has happened quite a bit. So we originally have the school district with a component unit that applies the definition and displays their component units on their financial statements. Then the municipality does all of their application of the standards, applies that definition and the display standards to the school district's financial reporting entity, and they determine that this school district needs to be rolled up into the city's financial statements. So again, keep it separated, but each piece has to do their own assessment of what needs to be included.
Yeah, so in this case, Becky, the municipality doesn't reevaluate the school district's evaluation of what constitutes a school district component unit. It focuses on the school district as a single financial reporting entity when evaluating whether it's a component unit of the city.
Right, and they keep everything that was reported in that school district report gets reported in if they determine that that's going to be rolled up into the city's financial statements, right?
Yep.
So in this instance of next level free knowledge, how should transactions between a primary government and its component units be reported in the financial statements of the financial reporting entity? Well, any resource flows between the primary government and any blended component units will be reported as internal activity. Think about this just like if it was a fund and you were reporting interfund activity. It's the same scenario here if it's blended. You're just treating it as a blended fund. Any balances that are owed between the primary government and a discretely presented component unit would be specifically identified and reported as due to or from discretely presented component units or primary government, so that the labels will specifically identify that that relationship is between the component unit and the primary government. And then any transactions between discretely presented component units and the primary government should be reported similarly to external transactions. So, like any of your revenues and expenses should be handled basically separated and grossed up, so to speak.
Thank you, Becky. Our second to last poll question, number 7. Who decides which of a primary government's component units are major? The GASB, the Government Accountability Office of the federal government, the primary government, or the Internal Revenue Service? This question should be just about as difficult as the one with the blender settings on it. But while you guys are thinking over this, are there any other questions that have come up?
We do
We
have
do have a
one
question.
more question, Dean. Yeah, there's one more question that's been posed on the Q&A. This one has to do with fiduciary component unit. So the question is, how would fiduciary component unit be reported after GASB 103? Would the condensed financial statement note disclosure be eliminated?
All right, so fiduciary component units are always reported in the fiduciary fund financial statements. They are never reported in the government-wide. And we're now going to, most of the rest of the webinar is going to be about fiduciary activities, so we'll really drive this point home. But things like pension and OPEB plans and private purpose trusts, those resources don't belong to the government, so they are always reported in these separate fiduciary fund financial statements. So the major component unit determination doesn't apply to them. I think you could probably say there really are 3 ways to report component units: discretely presented, blended, and fiduciary. And because those fiduciaries are reported entirely separate from the government-wide and the fund and the governmental and proprietary fund financial statements. So what's our, let's see how, if anybody decides they're going to poke me. No, the GASB doesn't decide. GASB has set this very principles-based provision for determining whether something is a major component unit that is ultimately dependent on the professional judgment of the primary government. That's who decides whether something is a major component unit or a non-major component unit.
And that absolutely drives us auditors crazy because we want to have a formula that we can just apply.
And I think I probably mentioned this earlier, but it was a long time ago, and my memory's not what it was. Now I do remember talking about principles-based versus rule-based standards. Everybody wants principle-based standards until they get them, and then they want GASB to tell them how to apply those principle-based standards as if they had been written as rule-based standards.
So we've talked about how these component units look on the face of the financial statements. Now let's get into some of the required disclosures. We've laid out five required disclosure elements right here. Basically, you need to describe all the component units and their relationship to the primary government. So this is going to go up front in the summary of significant accounting policies. And this is where you're going to basically lay out what the component unit is, what their relationship is with the primary government. You're going to describe the rationale for the criteria to include it as a component unit. This is going to be is the primary government financially responsible? Does the primary government elect the component unit board? Things like that are going to be described within that SSAP for the component unit. And you're going to break out, or you're going to also include within there the method of reporting. Is it going to be blended? Is it discretely presented? Is it a fiduciary component unit? All these things need to be they're required to be disclosed. You're going to include the information on how to get separate financial statements for this component unit. Typically, what you see is you'll see the component unit's name and maybe the address or an email or a phone number, or how they could get separate financial statements for that individual component unit. And then any significant transactions with the component unit and the primary government, you might want to describe that and the nature of that transaction or those transactions would be included within this summary of significant accounting policies. So you have the notes. Required supplementary information should distinguish between the primary government and the blended component unit. To distinguish and to discretely present a component unit. Sorry. Basically, what happens here is if you're looking in the notes to the financial statements, what you'll have the primary governments maybe say their debt. And then after that, you're going to do maybe a separate section. It'll say component unit A, like solid waste authority, and it's going to list out their debt. So you want to make sure that that's distinguishable between the primary government and the component unit, so that the readers of the financial statements are able to tell like what belongs to what entity. Notes essential for fair presentation include the governmental activities, business activities, major funds, major discretely presented component units. Consider the nature of the significance of each discretely presented component unit relationship to the primary government, like we talked about earlier. You're going to, what's the relationship there between the component unit and the primary government. And then you need to determine which discretely presented component unit disclosures are essential for the fair presentation. Okay, so this is where a lot of professional judgment is going to come in to play. As auditors, we are always looking at stuff from a money perspective, right? So if they've got, if the component unit has large, significant amount of debt, that might be something that you want to present in the notes, right? Or if their capital assets are significantly large. All these things are going to play a factor. Not only that, it might be something that, like for pensions, you might want to separate out a separate pension that the component unit has. Even if it's not material, it might be something that you want the readers of the financial statements to know, hey, this component unit does have, maybe they're not a part of the FRS, maybe they have their own 401k or other pension plan. So that would be something that you might want to take into consideration. Another thing that you want to determine is whether or not you want to discuss the component unit and the MD&A. Again, this is professional judgment. Is this something that the readers of the financial statements would like to know about? What's going on with the component units? That we should put it up in the MD&A. And the same criteria for the notes in RSI should be applied to the statistical section, right? So you get down in the stats. Does the component unit, is it like a solid waste authority? Do we need to have statistical information in there about what's going on with the landfill or something? All these are things that should be taken into consideration.
Yeah. So in summary, Patrick, I think that because this is really so dependent upon the professional judgment of the primary government, the the standards are very clear on when major component units need to be included in the financial statements, but not very clear about, at least not very black and white about whether the notes for the primary government's financial statements should include information about those major component units as well. And that's, and that's really on a case by case basis. It doesn't mean if they include debt information for a major component unit, it doesn't necessarily mean they have to include major component unit information in all of the notes in capital assets and long-term liabilities and so on. It really depends upon each separate major component unit and each separate note disclosure requirement. So the fourth and last learning objective today has to deal with fiduciary activities and how governments classify the activities in which they act as a trustee or custodian over the resources that belong to someone other than the government. And that's the plain languagey explanation of what constitutes a fiduciary activity is these resources, these assets belong to somebody else, to another government, to a retired employee, somebody other than the government. So these are not the government's assets, and that's why they don't get reported in the government-wide or the governmental or proprietary fund financial statements, because they don't belong to the government, and the government can't use them. And likewise, any debts related to those resources are not debts of the government. So that's why they're reported in fiduciary fund financial statements. Now, the precise standards are a little bit more complicated than that. Most of them come out of Statement 84, and it's a process to walk through. And anybody who's been around for 10 years or so will remember the process of evaluating all those activities to determine whether they were fiduciary and therefore should be reported in fiduciary fund financial statements. The way I like to look at this is that there are essentially four paths to an activity being classified as a fiduciary activity, and it depends upon the answer to two questions. The first question is, are the assets held by a component unit? And if they are, then the second question is it a pension or OPEB arrangement? If the answer to that is yes, that's the first path to being identified as a fiduciary activity. If it's a component unit and it's a pension or OPEB arrangement, it's a fiduciary activity. If it's not a pension or OPEB arrangement, then the GASB standards lay out some criteria. And if those criteria are met, that's your second path to being a fiduciary activity. If those criteria are not met, it's not a fiduciary activity, and it should be reported in the government's financial statements, government-wide, and then either in the governmental or proprietary fund financial statements. If the answer to that first question about assets being held by a component unit is no, you still ask that second question, is it a pension or OPEB arrangement? If it is, and if the government controls the assets, we'll say more about that in a moment, then that is your third path to being a fiduciary activity. If it isn't held by a component unit, it isn't a pension or OPEB arrangement, there is another set of criteria that the standards lay out. And if those criteria are met, that's your fourth path to being a fiduciary activity. Now, I'm going to go through these in more detail in a moment. But this just as a way to think about this graphically, I think lays it all out. There are four ways to fiduciary heaven, and it's going to go down one of these paths. But that's not as complicated as it sounds like because there's a lot of similarity for each of these paths. So looking at this here, the assets are held by a legally separate entity that meets the definition of a component unit, and the assets are held for pension and OPEB arrangements. That's a fiduciary activity. If they are held by a component unit but not for pension or OPEB arrangements, if the assets are at least one of these three criteria, it could be more than one, but if it's at least one of them, it's a fiduciary activity. The assets are held in trust or an equivalent arrangement, and the government itself is not the beneficiary, or the assets are held for the benefit of individuals, and the government does not have direct administrative involvement or direct financial involvement, it's a fiduciary activity. And we'll talk again about that terminology in a moment. Or if the assets are for the benefit of organizations or other governments that are not a part of the financial reporting entity. You hit any one of those three, it's a fiduciary activity. Then those other two paths for assets that are not held by a component unit. If the assets are held for a pension or OPEB arrangement and the government controls the assets, it's a fiduciary activity. Um, if it's not held by a component unit and it's not a pension or OPEB arrangement, uh, but the government controls the assets and the assets don't come solely from the government's own source revenue, like its taxes or its grants, and the assets are not derived solely from grants, government mandate or voluntary non-exchange transactions. Those are fancy accounting terms for intergovernmental grants or private grants, with the exception of pass-through grants for which the government does not have administrative or direct financial involvement. Any other grants, if as long as it doesn't come from that and it doesn't come from own source revenues and the government controls the assets, you're still in the ballpark here to be a fiduciary activity. The one last thing that's required is that it meets one of these three criteria, which we just saw on the preceding slide. As long as it meets any one of these three plus everything above that, obviously this is the hardest way to become a fiduciary activity, but it's meant to ensure that if they're not being held by a component unit and they're not for pension or OPEB arrangements in which the government controls the assets, that it really needs to meet these criteria where the government is responsible for these as a trustee or custodian before they get treated as a fiduciary activity and reported outside of the government-wide financial statements. Uh, GASB doesn't really define what administrative involvement and financial involvement are, but it gives examples. So administrative involvement might be monitoring compliance with the requirements of the activity or determining what expenditures are eligible, or it may have the ability to decide how assets are allocated. And then examples of direct financial involvement might be the government provides matching resources for the activities. Again, a lot of professional judgment is involved in assessing whether there is direct administrative and financial involvement. Control of assets is a little bit clearer. If one or both of the following are true, a government controls the assets. Either it holds the assets and or it has the ability to direct the use, exchange, or employment of the assets in a manner that provides benefits to the recipients. So use here means expending or consuming an asset for the benefit of others apart from providing services to them. So this isn't the government providing resources. This is providing services. This is something entirely separate from that. If a government happens to appoint a designee to act on its behalf, that's not relevant to determining that whether the government can use, exchange, or employ the assets. And then lastly, there may be restrictions on how the assets can be used, but that by itself doesn't mean that the government does not have control over them in this context. Here's, I think, probably our last next level FRE knowledge. How should a government report an activity in which it splits the revenue 50-50 with another entity? Whose portion, sorry, I'm misreading this totally. How should a government report an activity in which it splits the revenue 50-50 with another entity and that other entity's portion is held in a trust? Governments in this circumstance have two options. They can report two separate funds with the assets that belong to the external entity in a private purpose trust fund, or they can report the entire thing in a special revenue fund with the assets that belong to the external entity being reported as a liability. Becky,
All
I
right.
think.
Yeah, I'm taking over here. So how do we report this fiduciary activity? Uh, well, first of all, we never report it in the government-wide financial statements. We're only going to report it in our fiduciary funds financial statements. And we're going to show this aggregated into one of four classifications. If we have any of those pension and OPEB trust funds, that's going to be a separate column. Then we also have two other designated columns by the GASB, which is for either investment trust funds or private purpose trust funds. And then our fourth and final column is for our custodial funds. And so here, again, that first column is going to be for any resources that are required to be held in a trust for any members or beneficiaries of pension and OPEB plans. And all three of those first three are going to need to be administered through a trust. So that investment trust would be the external portion of any investment pools that are reported by the sponsor and government. And then our private purpose trust column is for all other trust arrangements under which there are principal and income benefit, principal in which the principal and income benefit individuals, private organizations, or other governments. Again, all of those have to meet the criteria in codification section 1300, paragraphs 112 to 114, or are addressed in the multiple pension and OPEB standards, which is not just going to be GASB 67 and 68. It's also GASB 73 and I believe 76 that all touch on different pieces and parts of trusted pension and OPEB plans. And then our ending column, our custodial column, is for those resources that we've determined are held by the reporting government in a purely custodial capacity, which is what all of those criteria that Dean mentioned take us through. This is what we previously called agency funds, although I will tell you that a lot of what we previously put into agency funds is no longer considered fiduciary in nature and has had to be put into either special revenue or into the general fund. So we've had a lot of changes because of GASB 84 based on those definitions. So again, trust criteria for pensions and OPEBs, contributions from employers and non-employer contributing entities to the plan, and earnings on those contributions have to be irrevocable. The plan assets that are dedicated to providing benefits to the plan members need to be in accordance with benefit terms. And the plan assets have to be legally protected from creditors of the employers, any non-employer contributing entities, plan members, and the plan administrators. For other arrangements, which again is some of those later GASB standards that came out and said, oh, we realize now we actually have more than just the traditional pension and OPEB. We still basically have to apply the same three sets of questions that Dean mentioned earlier. At least one of these has to apply, that it's held in a qualifying trust and the government itself is not the beneficiary, that it's for the benefit of individuals, and the government does not have any direct administrative involvement or direct financial involvement, or it's for the benefit of other outside organizations or governments that are not a part of the financial reporting entity.
Thank you, Becky. Okay, one last poll question. We're at a little bit over time, so we're going to pose this question, and then Becky, if you could move through the last handful of slides while people are answering. The question is, prior to Statement 84, what were custodial funds called? Janitorial funds, caretaker funds, guardian funds, or agency funds? Tell you what, Becky, why don't we skip over this one since it's kind of deep and this one as well.
Well, Dean, we want to keep talking till 4 o'clock to make sure all of our listeners have enough time in.
Yeah, I mean it's quarter of now. We're I think technically we're supposed to go to 40 minutes past the hour, right? 100 minutes. So anybody who dialed in right at the start is has met their 100 minutes.
We have the full 2 hours. But anyway, so some more next level free knowledge. Are there any circumstances under which a custodial fund activity does not have to be reported in a custodial fund? And the answer is yes. There are in business type activities and enterprise funds some circumstances where those may report assets with a corresponding liability that otherwise should be reported in a custodial fund if those assets upon receipt are normally expected to be held for 3 months or less. So we've got a little bit of a time exception here that's available to our enterprise funds. If a business type activity or fund chooses this option, remember that we need to separately report any significant additions and deductions as cash inflows and outflows, respectively, in the operating activities category of the statement of cash flows. For student activity funds, now this was something that came up a lot during GASB 84 and caused a lot of controversy and a lot of questions at the GASB. I'm sure you heard a lot about that, Dean. But, the question has been, are student activity funds a fiduciary activity? And the answer is there is no universal answer to this. The GASB has published at least 12 question and answers to address all the different permutations of this question. And you can see the references to all of those. But you basically have to apply the criteria that we have gone through today to the student activity funds. And the basic questions are whether the student activity funds are legally separate, who holds the assets, which is that control of the assets slide that we talked about. And then, do we have any administrative involvement? Who decides what fees can be charged? Who decides how the resources may be spent? Whether there are policies covering how resources may be spent. So just having to go through that decision tree of GASB 84 to determine. And what we've seen is that in most circumstances, at least I know in Louisiana, we've considered these as special revenue funds in most cases because there was, administrative involvement in most cases. So here are just some examples of the statement of fiduciary net position. This example gives you the first three required columns, and then we have a non-trusted external investment pool that's separated out from the other custodial funds. So just a pretty comprehensive example here. Is there anything else you wanted to say about this, Dean?
No, I picked this one so everybody would see this. It's a rather rare instance, but when it does happen, rather than being aggregated with the other custodial funds, GASB does require it to be in its own column.
Because of that external pool nature
Yes,
and being transparent that that really is a different type of fund from the regular custodial funds.
agreed.
Yeah. And then here's your combining statement of fiduciary net position. This is for private purpose trust funds, just to show that if you have multiple, you would combine those and then send the total to the statement of fiduciary net position. And you do that for both your fiduciary net position and changes in fiduciary net position schedules.
Absolutely. Thank you, Becky. So we are pretty much done here, but I did want to share one more thing with you before saying goodbye. If you go look at paragraph 901 of codification section 2100, this admittedly non-authoritative but incredibly useful flowchart that GASB maintains that really walks you step by step through the various questions and applications of professional judgment that we've talked about today. Um, Keep your eye open in your email for a resource from CRI that will attempt to replicate this in a little bit more plain languagey manner and a little bit easier to follow. This is a very complex flow chart, and we'll have that out to you sometime in the next week or two. And with that, I just want to say thank you to all of you for joining us for what is a very challenging topic. Please don't ever hesitate to reach out to any of us or any other expert at CRI with your questions about the financial reporting entity or any other aspect of governmental accounting and financial reporting. And be sure to connect with us on social media to find out about our future resources, our future webinars, and other offerings.